Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, like, share, send it around, spread the word. My guest today is Naveen Mallela, Managing Director at JPM Chase and head of Onyx Global Coin, one of the most interesting blockchain projects coming out of a bank. The blockchain world has been about digital assets, but what about the liability side? I spoke with Naveen about the ideas around deposit tokens, what they are, how they're different from stablecoins or CBDCs, use cases, risks, and regulation. Naveen Mallela, welcome to DigFin VOX.
Thanks for having me, Jim.
It's a pleasure to have you. Last time we chatted was in Singapore about a year ago, and things have been moving in the blockchain tokenization world very quickly since then. I know that at JPM Chase, you guys at Onyx have been doing quite a lot in this space, and I wanted to use this time with you to understand some of the terminology that's coming out of the research from the bank side, and put that into some sort of context for people that are, whether they're on the finance side, TradFi, or they're in the crypto space, or they're in the tokenization space, somewhere in the middle, just to kind of get a sense of where we're going with products, regulation, and really the future of money itself. So let me start with deposit tokens. I'm going to go back to a paper that you put out only a little while ago, and I'm just going to read your definition of this, and then I just want to sort of break it down into its component parts so we really understand when we talk about deposit tokens, because there's a lot flying around between this, stable coins, CBDCs, and then public crypto. So I think it's useful to understand it. So you're calling deposit tokens transferable tokens issued on a blockchain by a licensed depository institution which evidence a deposit claim against the issuer.
Yeah, Jim, and maybe to put the deposit tokens in context, I would like to sort of maybe take a step back and start talking about how deposit tokens came about from all of the work that we've been doing over the last few years. We've spoken, I think, a few times about JPM Coin and what we were trying to do with JPM Coin, which we've launched in 2020. So JPM Coin is essentially a bank account on blockchain.
Mm-hmm.
So what we were looking to do with JPM Coin was introduce a new subledger to the bank, which is distributed ledger based, so that we can provide capabilities around always on money 24/7. We can provide capabilities around triggers, programable triggers. We can provide capabilities around atomic settlements and multi-asset ledgers. So we wanted to do all of that without fundamentally changing the construct of a deposit. So what we did was we essentially kept the same definition: a deposit account, a bank account, FDIC protected. So and for all practical purposes, from both a legal definition standpoint and a regulatory standpoint, it's no different than a regular demand deposit account. We've had considerable success with the product over the years, but one of the limiting factors with a deposit account or a bank account on blockchain is the transferability or the reachability aspects of it. The account can only be used in transacting with parties who are also account holders at JP Morgan. So it's essentially a closed loop system, which is 24/7 and which gives you all of the benefits that we spoke about in terms of programmable triggers, atomic settlements. With deposit tokens, we wanted to break that constraint a little bit and start looking at how we can reach to entities or individuals who are not necessarily account holders of JP Morgan. And the way you do that, we think, is that with the evolution of some of the capabilities, especially digital identity solutions, we could start looking to get comfortable with credentials, with verifiable credentials provided not necessarily by JP Morgan, but by a trust anchor of some sorts. A trust
What would be
anchor.
an example of that, for example?
Like, for example, in correspondent banking, like we routinely rely on the KYC being done by the banks who avail of the correspondent banking services with JP Morgan. So we don't do the KYC, but we rely on the KYC of the parties who bank with us. So we think that the similar sort of notion could apply out here as well with deposit tokens. The entity who is transacting with a deposit token issued by JPM could potentially have verifiable credentials issued by some other bank, or it could have a national identity of some sort. So that is how we think that we can address some of the weaknesses which are frequently cited in terms of KYC weaknesses, which are frequently cited with bearer tokens kind of a model. So that's how we're thinking about it. We are looking to improve the reachability, and that's the point about transferability.
What's the importance between, you're talking about accounts, but you're also talking about helping people that, or serving users that may not have a bank account with you. So in the blockchain space, we often, deal with tokens that represent a virtual, they're basically an asset or something in some sort of virtual form. We don't really hear about deposits or liabilities in the crypto space. It seems to be purely asset driven, which I think is a big difference between that and a commercial banking, system. You're trying to bring some of that liability side into the equation here, I think. But help me understand when we're talking about tokens versus accounts.
Yeah. So, James, that's exactly right. Like, I feel that the digital asset space, is this all-encompassing sort of term which covers everything. But it's not just us. Like, JPM Coin is a liability product. Central bank digital currencies, especially the wholesale sort, I would argue are a liability-based product. So, and I think some of our peers have looked at correcting the definition with the launch of the regulated liability network. So what we're looking to do with a token-based model is, if you think about what I talked about JPM Coin, right? Like the transferability is limited to other account holders. Now you could have a world where you replicate the two-tier architecture of central bank money and commercial bank money, and central bank money providing the fungibility on blockchain, on distributed ledger rails, and that will solve for some of the pain points. And that is something which is an immediate next step which people are gravitating towards. But to create truly peer-to-peer money, like for example, let's say I'm sat out here in Singapore, you're sat out there in Hong Kong. How do we truly create peer-to-peer transferability or peer-to-peer transfers without having to go from account to account to account? So that we think is basically the token-based model. And if you think about the token-based model, if you believe in a world where DeFi protocols especially have relevance in the institutional context, whether that is automated market making or whether that is decentralized exchanges, lending borrowing protocols. So all of those DeFi protocols need a token-based model to interact with. With an account-based model, they don't lend themselves to interaction with these DeFi protocols. So for all of those things, we do need to take that next step from an account-based model to a token-based model, which is of a bearer nature of some sort.
What does that imply for commercial banks that have based their entire existence essentially on that fundamental building block of an account deposit? Can you transition yourself into something that's more token based? And what does that imply for, I guess, your own access to deposits so that you can then be a lender and fuel the credit economy?
Yeah. So, the way we are defining deposit token is that it is purely on the liability side of the balance sheet. We don't see the issuance of deposit tokens or the takeoff of deposit tokens impacting the asset side of the balance sheet. And we've been quite deliberate about that approach. And we think that that's the fundamental departure between deposit tokens and stable coins. If you think about stable coins, which need to be backed one-to-one with high quality liquid assets, our argument is that that is narrow banking, that sucks up a lot of liquidity, and it is not scalable. Our view with deposit tokens is we as banks, the recent events notwithstanding, if you look at GSIPs, for example, you're subject to constant stress tests. You're subject to prudential regulation in terms of capital, having adequate capital buffers, having adequate liquidity buffers. So we envisage a world where deposit tokens are issued purely as a liability product without any change to how you manage the assets in terms of the reserve ratios. So from a commercial bank standpoint, where it would need to sort of move to start looking at this product at scale is commercial banks need to start getting comfort around shared ledgers and universal ledgers as books and records, because that is where the liability will reside. They will need to start getting comfortable around KYC being done by other trust anchors and relying on verifiable credentials. You need to start getting comfortable around looking at on-chain surveillance solutions or on-chain screening solutions rather than the current surveillance and screening solutions that you have. All of those things are things that commercial banks need to get comfortable about. But I have no doubt in my mind that today the dominant form of money is commercial bank money. Even in digital currencies world, that's not going to change. So commercial banks will have a large role to play, and that's the reason why you see that there is a lot of literature starting to come around tokenized deposits and deposit tokens and how that can interact with CBDCs to create solutions at scale.
What does that imply for efforts that are going on in the public permissionless blockchain world? Let's say Ethereum, for example, which now has introduced the ability for people to withdraw and staking, and they posit this as being similar to a bond function. What that means from a regulatory point of view, I don't know, because then that's implying securities. But leave that one aside for just a moment. Is it possible that the crypto world in the public sphere could come up with something that, maybe you don't need a deposit, tokenized deposits from a commercial bank? Maybe they can create their own sort of quasi form of liabilities. Do you have a take on what's happening there, and if that qualifies as true liabilities and therefore some sort of true credit?
So, Jim, my view is that all of those solutions are unlikely to scale, right? Like if you believe in the fractional reserve banking, I mean, now it could be argued with the recent events whether you believe in it or not, but if you believe in that model, the fractional reserve banking model, and if you believe in commercial banks creating credit through the money multiplier, the only scale form of digital currencies is going to be commercial bank money, because anything which is done by a non-depository institution will be a more narrow form of money. So which means that for every token which is issued, you will need to have HQLA of some sort. And I mean, regardless of a blip recently, we live in a world of quantitative tightening, right? Like liquidity is going to get scarcer and scarcer. So high quality liquid assets, as an example, there will not be enough of that going around for scale solutions to come outside of depository institutions.
Do tokenized deposits, will they exist in a world without central bank digital currencies, or are CBDCs like the sine qua non, the necessary ingredient of having tokenized deposits?
The where CBDCs come into being is providing that singleness of currency or the oneness of money. We've had in history private bank notes, and there were issues in terms of them trading at par against each other. You had to have clearing houses of some sort. And where the two-tier financial architecture addressed that was providing that fungibility and creating that singleness of money, which I think is going to be critical if you wanted to use tokens or money to discharge payment obligations. So I do think CBDCs have a role to play in terms of creating this fungibility, but I don't think that you need to have everything in place for this to take off. Commercial banks and institutions, especially GSIBs, could start with deposit tokens. There will be a high degree of credibility, so they would most likely end up trading at par. And as they start scaling, then the need will be felt for CBDCs to provide that fungibility across these various commercial bank tokens. So that's our belief, and that's the reason why we are pushing for deposit tokens to be initiated to start giving impetus to this ecosystem.
You've already got JP Coin, but school me up on where that has evolved. I mean, I understand that is at this point a payment mechanism among your own existing clients within your own private network of actors. What has to happen for that then to become an actual deposit form that people use and they bank with you in that manner?
So the JPM coin, or which is, as I said, a deposit account on blockchain, is being actively used by our clients today. And the way they use it is as a 24/7 clearing and settlement network across JP Morgan franchise. So it almost sits like a layer two above our regular core banking systems, which are layer one. That's already happening. The second place where it's being
Just to
used,
confirm that, then the actual settlement takes place in your traditional banking system, and this is more than just an enabler of information and value to transfer among them.
not really, Jane. That is where this is different. This is a new subledger which has been introduced into the bank, which sits at the same level as the other core banking system and feeds the general ledger.
Okay.
So when money moves on this subledger on this JPM coin system, the settlement is final.
Okay.
So you don't have the need to actually go off chain. So there is no mirroring of any sort which is happening. So that is one, and there has been examples in the past of Signet or Silvergate Exchange Network, SEN, of networks of this sort which no longer exist. So this is in the same vein, but it does more, and it does that at scale. Where it is also come into being is as part of a multi-asset ledger. So products like intraday repo, where you have a repo transactions for 2 hours or 3 hours. That is where both the JPM coin as cash on chain and the tokenized securities in a single block, you have basically the exchange done in an atomic fashion. That is what makes products like intraday repo happen. If you were to do it with traditional systems, it would be very difficult for you to, let's say, do a 2 hour intraday repo, because trying to reconcile whether cash has moved, securities has moved, and unwinding it all back will take a lot longer than 2 hours. So this notion of, recently BIS has spoken about a universal programmable ledger. So these are the sort of multi-asset ledgers which we are already live with, and that is where JPM coin is being used.
Yeah.
And as I said, the next evolution of this is to improve the reachability, and that is where we need to imbue it with bearer token-like properties, and that is where we see it going next. But we see both of them coexisting.
And when we talk about those bearer-like properties, does that mean it would then have to somehow take on a life outside of your network, in public chains as well as as well as shared ledgers?
That's exactly right, Jim. So our view was that public chains provide the best reachability. Most recently, that different regulators have come about, like in terms of clearly stating that they believe that the risk profile of public blockchains is significantly different from that of permission blockchains. So we do see it as an evolution. That's where we want to go to public blockchains. But before that, we see deposit tokens as taking a life outside of our networks in other permission chains.
Okay.
We see it as different form factors, if you will, to use the technology phrase, right? Like, it's the same deposit, but there are different form factors. One form factor is the account form factor, which is the JPM coin. The second form factor is that sitting on other permission chains. So that's how we see it.
Naveen, what's the regulatory implications of this? We're talking about essentially TradFi models transported into this new technological environment. And I think for most regulators, they like to think of themselves as tech agnostic, right? We hear that all the time, which I think most people agree with, I guess, in principle. But how much of what you're talking about is going to be possible to just use existing regulation and norms around capital requirements, risk management tools, et cetera, if we're dealing with tokenized deposits and essentially sort of commercial banking transported into a blockchain setting?
Yeah. So the latter part of it is easier, Jim. Commercial bank products transported into blockchain realm. That's what we've done with JPM Coin. And there we've been very deliberate about using the same controls, whether that is same monitoring, same surveillance, same sanction screening capabilities. So we've had this thin sort of subledger, but then which is connected to the mothership in many different ways. And that is how we've got our agencies comfortable with what we're doing. Deposit tokens, by its very nature, being bearer tokens, being outside of the bank in different permission chains, will need to break away from that model a little bit. So, like, for example, one of the things which we do think is quite important for deposit tokens is the notion of deposit insurance. So, like, and we do need to work with the likes of FDIC to understand how, when a token issued by JP Morgan is held by a non JP Morgan entity who doesn't have a contractual relationship with JP Morgan, how can then they get access to deposit insurance of, to which JP Morgan contributes to?
Is there a lesson from the Eurodollar market? I mean, Eurodollars are US dollars held in overseas banks by non-US players, right? And they interact with the dollar system pretty easily, but nonetheless, they're not FDIC protected, and they're really sort of out of the immediate purview of US regulation. So is that a sensible comparison?
There might be players who might want to draw upon that comparison, not for us, James. I mean, we would want this product to be available squarely out of our bank entity based out of the US.
Okay.
That is our preference, because we think that is going to be the scale solution if you want to start offering US dollar deposit tokens. So yeah, I mean, in terms of where regulations need to involve, we need to think about deposit insurance. We need to think about things like screening, right? Like inline screening. Recently, Japan has come up with stablecoin regulation and legislation, which they're going to put an act in the next couple of months, where they're looking to looking to have controls imposed only at the point of off ramps, for example, when you're trying to withdraw, and not necessarily doing it during transfers. I don't know if that sort of model will be the model going forward. Yeah, I mean, so we do need greater clarity and harmonization to a certain extent of the approaches being taken by the different regulators.
Right, but then you're also implying that you're in Singapore, I'm in Hong Kong. The two of us could be transacting. We have, you bank, I guess, with JP Morgan Chase. I bank at HSBC, and we could be transacting. It has nothing to do with the U.S., but you would still have some layer there. One of the counterparties would still have FDIC, U.S. FDIC insurance. Is that the vision that you're talking about?
The vision that I'm talking about is, as long as you and I are transacting where you're a customer of HSBC, the fact that now I've transferred a JP Morgan issued deposit token to you, James, means that you have deposit insurance at that point in time.
Right. Okay.
Right. Yeah. So that's the world we would ideally like to propagate.
So that's very interesting, right? You're sort of externalizing that deposit insurance. And what else? You're because you're in Singapore. I know you guys work very closely with the authorities there on a variety of things. You're co-investors in Partior, a shared blockchain network with Singapore Inc. Entities. What are the issues? You started off talking about, we've been talking about U.S. based financial institution, and you want to extend U.S. sort of regulations and norms across what you're trying to do here. How does it work working in other jurisdictions? Asia, there's a lot going on. Will they be bringing their own sort of flavor to this? How do we find some means of agreement or live and let live so that you can accept FDIC insurance on a deposit in Singapore or Hong Kong while still being compliant with MAS or MA or whomever is regulating that space?
Yeah. So, Jim, again, we need to see how this space evolves, right? Like, and this is where there are bodies, FSB, BIS, looking to sort of bring some degree of harmonization in terms of how you think about these things. Yeah. One thing which is very heartening is almost everybody is thinking about deposit tokens. And I would like to draw the distinction between tokenized deposits and deposit tokens, because I mean, it's what is not well understood is, like, if you look at tokenized assets, right? Like, it's well understood. You have an asset which is in custody somewhere, you tokenize it, and what you have now is a claim on something which is custodied somewhere else.
Yeah, a derivative essentially.
Yeah, a derivative. Whereas we look at it as native issuance, right? Like deposit tokens is a native issuance. This is the primary books and records. There is no off-chain thing which exists.
Right.
So that terminology apart, I think almost everybody's talking about deposit tokens, the need for harmonization in terms of how that is treated, either from a FATF standpoint, travel rule standpoint, either from KYC or from an FDIC, capital requirements, liquidity requirements. So we'll just have to wait and see how this evolves. But Japan's got the lead, Singapore's got the lead in terms of pushing out consultations in terms of stable coins and deposit tokens. So we would see a lot more emergent products from this part of the world. But as I said, given BIS, FSB, and all of the involvement, we would hope to see a degree of harmonization.
Yeah. One last question, sort of, I guess, culminating from what we've been talking about, Naveen, is in the U.S. This past spring, of course, we've seen several rather unsettling bank runs done in the Silicon Valley Bank lost 42 billion deposits in a single day as people were just tweeting and on their phones, just zooming it all out. So although bank runs are nothing new, the speed and the digitalization of that run was, I think, surprised a lot of people and led to it very difficult for the Fed to be able to respond in time. When we're talking about FDIC coverage and so on, that's, the importance of insurance, I think, has been only brought home even more strongly after that incident. What are some of the issues of bank runs when you got a 24/7 global marketplace with automatic market makers, DeFi protocols, and so on? If you end up with tokenized deposits, could you end up with, if there's some change in the macro, there's no central bank that's necessarily on these rails directly to provide that backstop. So how do we risk manage this thing?
Great question, Jim. And I think that this is pretty fundamental, right? One of the things that is often missed in the failure of the Silicon Valley Bank was the fact was that 4 p.m. on a Friday, they were unable to execute a repo transaction because of Fed cutoff times. They were unable to source liquidity even though they had perfectly good collateral. I was asked a similar question at one of the BIS conference, and my response is actually that's the wrong way to look at it. I mean, yes, in this digital world, right, like everything is becoming 24/7, would it not exacerbate bank runs? You can't control the front end and the consumer behavior. That's where the world is going towards. What is the need of R is to strengthen the core, strengthen the back end. I would argue that products that we do like intraday repos or what we've done with institutional DeFi last year through Project Guardian in terms of creating deep pools of liquidity, what that means is that it would allow, in situations like this, banks to tap into multiple sources of liquidity at a very short notice. So the core starts keeping pace with the front end behavior. So that point is often missed. And we think that the work that we are doing creates a lot more resilience in the core.
Okay, great. I think that's a good place to end it. I just want to last thing, because I started with this, so I want to end it in terms of talking about again that definition of deposit tokens, and again that's evidence of a deposit claim against the issuer. I guess what you're saying is if we have multiple issuers with these multiple deposit claims, and we may not have necessarily a 4 p.m. close of the Fed window to rely on for these things, but essentially that you need a huge amount of counterparties in this world so that these claims can be traded, swapped, whatever, in time to make sure that there is the liquidity and capital available when there's going to be a glitch, because there's always going to be some kind of glitch. So I guess that's, yeah. So I guess to that extent, then what you're really aiming for is when we talk about these issues around regulation, around risk management, and so on. And I don't want to say interoperability per se, but let's say the bringing together of regulators that can have some harmonization and agreement on this, whether that's being willing to extend deposit insurance overseas or finding ways to manage risk when something happens in a different time zone outside of your jurisdiction. The main response to this seems to be that the depth of the marketplace is at this point going to be the best defense rather than trying to create lots of bilateral one-on-one very fragile structures like that.
That's exactly right, Jim. And we have the ability to do that, and we have the ability to increase resilience in the financial infrastructure, and that's what we're excited to building towards.
Great. Naveen Mallela, it's been an absolute pleasure speaking with you. Thank you so much for your time today.
Always a pleasure speaking with you, Jim. Cheers.